I first wanted to thank the Center for Asset Securitization and Management in Asia at Singapore Management University for the invitation to speak with you today. Singapore Management University is a very important institution to Cambridge Associates. We have several graduates working in our Singapore office and one graduate working in our new Beijing office, and are thankful for the wonderful graduates they produce and for SMU serving as a focal point of learning in finance and economics in the region. I first wanted to provide you a short background on Cambridge Associates. We're an investment consulting firm, which means we provide investment advice and research to our clients. Cambridge Associates currently has over 900 clients and 2.6 trillion in assets with those clients. And we have 8 offices globally. And as I mentioned, we have an office here in Singapore with a little over 30 people. And we just recently opened our office in Beijing. Our client base consists of university endowments, foundations, sovereign wealth clients, pensions, and family offices. We're happily celebrating our 10th anniversary here in Singapore and look forward to many years to come. I thought first I would start by defining the role of a consultant, which I think is aptly described in this cartoon. And those of you that can't read, it says, "I know nothing about the subject, but I'm happy to give you my expert opinion." But what we do is spend a lot of time evaluating managers. And so what I thought would be helpful is to talk about the challenges of raising institutional capital in Asia. And my apologies beforehand, it will come from a Western perspective in the sense that most of the institutional capital today, although Asia is growing rapidly, is still from the United States and Europe. I would warn that this is one consultant's perspective with specific biases, and you might hear different perspectives. But I thought it'd be a practical topic because I found that in talking to managers, many to be frustrated by the lack of success in raising institutional capital outside of Asia, especially the smaller managers. My agenda today is to first try to discuss some of the challenges, to provide some advice on those challenges, and to focus on what we think is very important, which is appropriate alignment between the investment managers and the investors. And then hopefully leave some time for the end of Q&A. I would also like to say that we think the opportunity is tremendous for asset management in Asia. In terms of our clients, the interest in allocating to Asia, and we have a global client base, is uniformly positive. In terms of our global views, we have been recommending to clients that in terms of their strategic asset allocation, that over the long term, at least a third of their assets should be allocated to Asia. And if you take away any advice today, I would hope that it would be the following. Notwithstanding the importance of investment returns and process, institutions or institutional investors place a significant importance on organizational viability. They want to know if you're going to be there for the long term. Thus, it's extremely important to think about how to put in place the processes that will enable your firm to last. Especially to those who are starting out, I want to stress that the more thought you put into thinking about your long-term strategy, the more time you will have saved in the long run, because your business will go through a stressful period because the markets are always going to be stressful. So first the challenges. And so, of course, location. and distance from the larger institutional capital in the United States and Europe. And what we've seen over the years, if you take 1998, if you take 2008, you're seeing some evidence of now, is that those investors ex-Asia will redeem unfairly for uneconomic reasons. And that's because they're sitting over in the United States, and because Asia is so far away, and they don't feel like they can monitor it day to day or do the due diligence that they would like, they simply redeem the investment, even though there may not be fundamental reasons for that. Communication, of course, there's the language issues, but more importantly, there is an issue of transparency from what we've observed. And what we would say is that Asian asset managers are less transparent than they are in the U.S. and Europe, and that hampers institutional investment. And I want to talk about, later on what advice that we would have with that. And then infrastructure, this really relates to operations. And so post-2008, related to the financial crisis, and post, of course, Madoff, with the operational issues that were there, institutional focus has increased significantly on operational infrastructure, where it was, of course, thought as a significantly lower priority to investments. Now institutions are not only looking significantly at the investment process, but of course at the operational process. And while there has been material progress made over the past few years in Asian-based asset managers, I think they're still generally lagging behind those in the U.S. And in Europe. And unfairly, because of the distance, sometimes the Asian institutions are held actually to an even higher standard than the institutions, say, in the home regions of U.S. Or Europe. So how to mitigate the location challenge? Well, one suggestion, of course, and many of you all are doing this, is for the principals to travel to the big institutional markets, New York or London. And what I would emphasize is that it's not just, I'll talk about the importance of investor relations, but what I would emphasize too is it does, if you are to make those trips, it does need to be the portfolio manager or final decision maker. Because many of the institutions are not going to make a decision to invest, of course, unless they've met the boss, the final judgment person. And this will sound self-serving, but for efficiency purposes, I think it's very important to initiate a relationship with a gatekeeper, consultant, or advisor. You can realize significant economies of scale. Because if you have one good relationship with a consultant or advisor that has hundreds of clients, it may be that you only communicate through that advisor, and then they're communicating to hundreds of their clients, and that will save you significant time and significant meetings. And it always, and even in the U.S., it's always surprised me where investors, in terms of investment management firms, in terms of raising money, go around and they schedule 50, 100 meetings that may not be beneficial, instead of strategically saying who is a strategic advisor to all of these clients and is recommending proactively, say, investment managers. Of course, participate in international conferences. There are good ones and there are bad ones. And so I would say do significant research on who is going to attend those conferences, how they're going to match up with your investment process. And it might be wise to have a rep in the U.S. or Europe. And simply that is, even if it's one person that's in a closer time zone, who knows the portfolio well, who is in touch with the organization, obviously it's costly, and you think from a pure investment process it doesn't matter, but it does. Communication in terms of comfort from institutions and they have comfort in what's going on in the portfolio, it does mean a great deal. Emphasize investor communication. Managers need to view this process as a long-term relationship instead of a short-term sales pitch. A lot of these institutional investment due diligence, it could be a multi-year process. Especially for Asian-based institutional products, the large government pools, like the prospects like the sovereign wealth funds. Managers must be prepared to engage in knowledge transfer and really be a part of the education process. I mean, these institutions, it runs the gamut, but some of them have huge pools of money, but very, very constrained in terms of staff. And so they very much appreciate if you approach them in terms of education, talking about whether your asset class or your strategy, in itself a partnership. And I think that means a lot, and it'll mean a lot to you all's success in having success with those institutions. Investor relations is very important. And I've seen there's been many institutions that are just brilliant investors, but they will run into that pocket of trouble. And because they've been either non-transparent or they haven't had professional investor relations staff to communicate what was going on during that period of turmoil, assets have flown out the door. And I think it's a necessity to have someone who can talk about the portfolio in an articulate manner. We would, from our perspective, focus on institutional. We would focus on someone that emphasizes investment communication skills over sales skills. We think it's optimal to have that investor relations person sitting in the investment meetings so they know the portfolio backwards and forwards. And it can save the investment teams tremendous time, because obviously what you all want and you want your portfolio manager to do is be investing and not meeting with investors. And of course, if you have a good investor relations person, and there are many out there, and they can talk comprehensively and know the portfolio and know everything about the organization, that can save a lot of efficiencies. And then err on the side of over-communication. I can't tell you how many times I've seen investors not communicate something that if they just had communicated, had gotten it out there, it would have been okay with their investor marketplace. But because they were perceived as hiding something, there was a breach of trust. So even if you think something is trivial, I would urge that you communicate it with the perspective of thinking I'm over-communicating rather than under-communicating. In terms of operational infrastructure, not only are institutional investors demanding more robust operations, but managers are also having to increase staff just because of regulatory requirements globally. A comprehensive model today includes a chief operating officer, a chief financial officer, a compliance officer, a general counsel. Of course, in the smaller institutions, some of these roles might be shared. I think if you are a smaller institution, to compensate for the limited resources, make sure that you get someone with significant experience, and maybe someone who has been a CFO and now a COO, can handle both roles, or in terms of related to general counsel and compliance, those roles align as well. Of course, third-party administration, this is more focused on the hedge fund vehicles, is an absolute, as well as hiring high-quality auditors and prime brokers. And costs have increased. It is very expensive. And in terms of the cost to run your business now because of these new operational demands, in terms of the assets that you need to have to break even. But we would just emphasize that you shouldn't cut corners when launching at the beginning, that you should spend the time putting it in place, and I think it will save you a lot of heartache in the long run. So now I want to talk about the alignment between managers and investors. And what I would say is this alignment, again, thinking about the long term, is actually good business for you all as asset managers. The simple question is, are you a good partner? The relationship should be defined by well-defined expectations, clear communication, fair compensation, and mutual respect. I think institutional investors very much focused on, they are coming in as limited partners per se, and you as the general partner. So it very much is a partnership, and so if it can be balanced between your commercial motivations and their motivation as investors, I think that is good business for you in the long term. And what I wanted to talk about is three elements of that: transparency, equitable terms, and internal capital. We think transparency is extremely important in all facets. So the investment side, the operational side, your fund terms. Written portfolio transparency, of course, includes monthly reports on top positions, sector exposures, geographic exposures. And I can't tell you how many times I've talked to investment managers about writing quarterly letters. And I think that most see it very much as something they don't look forward to. But I think many will say that in writing it, they are able to think broad picture about their investment processes, what they're doing in the portfolio, and a lot of it can helpful from their learning and their improvement. And from an institutional investor perspective, there is a lot of good information that can be gleaned. And if you write a comprehensive quarterly letter, that will save a lot of phone calls because there's a lot of things that can be said, and those that do write investment letters where the end investor can get a good understanding of what's going on can go a long way. Verbal transparency might include quarterly call with all investors. I mean, anything that we are focused on when we're evaluating managers and something that we are going to recommend or looking into, we are going to require that the asset managers have a quarterly call with us. To save time, it may be for other investors to have a quarterly call, broad-based, every quarter, to talk about what's happened in the past quarter, and more importantly, what the current opportunity set is. Again, it's very important to communicate as soon as possible any organizational changes or term changes. I think if an asset management firm is making term changes, it's important to solicit feedback, especially from their strategically or their larger investors before they make those term changes. Again, I have seen asset managers make changes to their terms without any feedback, and that has caused a breach of trust. So again, in this partnership relationship, and then secondly is institutions do not like term changes. And so when you are thinking about changing your terms, obviously there can be very important investment reasons for that, business reasons, but also I think, be very focused on when you make those changes, what the consequences of that is going to be. And we hear this all the time. I know managers have competitive concerns. They feel like they're sharing trade secrets. But I certainly, there are a few exceptions, but I do not see a positive correlation between being less transparent and good performance. In fact, some of the managers that we like the best are actually the best communicators and the most transparent. Mutually beneficial terms. When setting up terms, again, the appropriate balance is important. Examples might include lower management fee resets tied to asset growth. When asset growth, of course, is increasing significantly, then that management fee may not be as necessary in terms of operating your business day to day. And so some institutions out here in Asia are doing this, and I think it does mean what it tells us is that they're focused on returns, not growing empires. Incentive fee clawbacks. Management fees and incentive fees are trending lower. We would have thought post-2008 that it would have been significantly different. It has been very incremental. I do think on the heels of even these past few months, and you've seen the underperformance of many hedge funds out there, long-only funds, that it is coming sooner rather than later, the inflection point. If you look from a hedge fund perspective, and you look at how many hedge funds have done, since the financial crisis, many have underperformed equity markets and bond markets. And so from an institutional client's perspective, paying 2 and 20 is something I think is going to change. And right now, the average is more on the hedge fund side, 1.5 and 20. But as I see new launches coming out there, there could be a 1.5 and 20 class, but that's going to be for a shorter term class, and then fees are coming down to say 1 and 15 on the trade-off of longer term lockups. And that's what I mean in terms of declining fee schedule if you do have a longer lockup. Lockups should reflect the liquidity of underlying strategies. If you are in a liquid Asian credit, to have monthly liquidity, I think, is something that's not going to match up with the duration of your investor base. And of course, if you are a high-frequency trader with very liquid securities, then liquidity is not meaningful. But if you're a long-term fundamental investor and you're looking, say, at stocks over a multi-year period to respond to your fundamental analysis, then to have liquidity that's monthly and investors and attract short-term investors that you'll have one lumpy return that month and then they'll flee. And I don't think that's an appropriate way to set up a business for the long term. This is the gold standard of alignment, and that is internal capital investment, because the size of your investment illustrates your conviction in your own investment process. Of course, newer managers, they're not going to amass the significant wealth in terms of being a principal component of the investment side. But what we will always ask is, what proportion of your personal assets? And that proportion of personal assets needs to be very high of your liquidity, X the real estate that you own, because that's what we see as the principled alignment between the institutional investor and yourself as asset managers. It's the single best way to lessen conflicts embedded in other partnership terms, because those conflicts are there. So, my 3 takeaways: focus on setting up your organization for the long term. The equitable alignment with investors is good business. I think that's a long-term greedy approach versus a short-term greedy approach. And then communicate.